Basics of cryptocurrency. The latest in investments is something that's not very clearly understood. While some people believe cryptocurrency to be the next gold rush, others believe it should not be spoken of. However, for people who are genuinely concerned about their investments and the way they invest their hard-earned money, it can be a Herculean task to figure out what to do. Once you understand the basics, it won't be very difficult for you to comprehend the scope of this technology that's promising to shake up the world. However, there is no dearth of these resources online, and trying to learn about cryptocurrency from the internet will only leave you more confused than before. You can't even afford to not know about cryptocurrency because that'll mean losses for you. There's tremendous potential in the cryptocurrency trading market. If you fail to capitalize on it, you're not only missing out on making profits, but you're also losing money that could have been made. So how do you learn about this bizarre new buzzword that everyone's talking about? You find a credible source that can summarize all the information for you in one place. This chapter will answer all your questions, clear up common misconceptions, and address your doubts about cryptocurrency so that you don't miss out on anything. What cryptocurrency is. The simplest way to explain what cryptocurrency is that it's a decentralized currency. It can be used online to be exchanged for goods and services, just like the money you hold in your bank accounts. Being decentralized means that no bank or country can issue these cryptocurrencies, and even the processing or storage is out of the hands of these entities. The money you hold in your bank account can be withdrawn as cash, but cryptocurrencies have no physical form whatsoever. Cryptocurrencies are just a set of data that are stored at multiple locations throughout the world. Almost all cryptocurrencies operate on the principle of blockchain technology, in which multiple computers all over the world are responsible for storing and maintaining records of transactions. It almost works like a cloud technology which many people are more familiar with due to the increasing use of Google Drive, OneDrive, Dropbox, and many other services. The security in this technology is the utmost priority, and all the data is stored in an encoded form. Even if there's any sort of cyber attack on one system, the others will still have the data intact. This also negates any possibility of fraud or currency counterfeiting since the records are maintained by many entities, and it's extremely difficult to cheat. These are only some of the various benefits of cryptocurrency explained in a very basic manner. The scope and depth of cryptocurrency extend far beyond any other monetary system. In the further chapters, we'll be exploring all of these features in detail to enhance our understanding of the various cryptocurrencies. Popular cryptocurrencies. There are so many cryptocurrencies in the world that it's not possible to keep count. However, most novices don't realize this fact, and they assume it to be a nascent industry that revolves only around the all-powerful Bitcoin. There are more than 2,500 major cryptocurrencies, and that number's continuously growing. But it's to be noted that only a few of these are important and you need not know about every cryptocurrency out there. Some of the most prominent cryptocurrencies that are traded all over the world are Bitcoin. The original cryptocurrency that everyone knows, Bitcoin was the first P2P eCash system ever. It was used for the first time in 2010, and its value has crossed more than $32,000, which is an astounding figure. Bitcoin has been at the forefront of the cryptocurrency revolution, and the products like Bitcoin SV and Bitcoin Cash have emerged in recent years. Ethereum. The second largest cryptocurrency in the world has shown a lot of promise, and it's expected to rise even more. The Ethereum blockchain is a vastly used platform all over the world. Ethereum doesn't only focus on the cryptocurrency side of things, it also focuses on the greater blockchain technology and its implementations. Dogecoin. This cryptocurrency originated as nothing more than a joke, and its value has skyrocketed from what it used to be. The reason behind this astronomical gain is the social media hype generated in favor of Doge. Even the owner of Tesla and SpaceX, Elon Musk, voiced his support for this cryptocurrency that further bolstered its position. Types of cryptocurrencies. You might think that there's only one type of cryptocurrency if you're not very well versed with them. This isn't just a misconception among the unaware investors. But it's also a very common misconception among veteran investors. However, it's best to know about the different types of cryptocurrencies from an informational perspective. It'll help you identify which cryptocurrencies are the major players and which aren't. The two major types of cryptocurrencies are coins. A coin-type cryptocurrency is what you must be familiar with, which is so for a good reason. The coins have their own blockchains, and whenever people talk about buying cryptocurrencies, it's usually this type that they're referring to. The most common cryptocurrencies of this type are Bitcoin, Ethereum, Ripple, and Litecoin. Tokens. Now, this is where things get a little bit more complicated. The tokens are usually built on top of another pre-existing blockchain rather than having their own. The examples of tokens are numerous, but the most easily understandable would be DApp, that runs on the Ethereum blockchain. Tokens are usually sold as an ICO, initial coin offering, when they're first sold publicly, which is similar to the IPO, initial public offering, in the stock market. Even these tokens are divided into two categories, namely the utility tokens and the security tokens. Discussing these tokens would take a very detailed discussion, and we wouldn't be discussing them here. Reasons behind popularity. Cryptocurrencies have risen to fame almost overnight. There are many theories as to why cryptocurrencies suddenly became so popular. However, just like all the theories, it's all just speculation, and there might be many other reasons at play as well. The biggest reason for this immense popularity is that people know how scarce these cryptocurrencies are. Bitcoin will keep on halving in value after a few years, and the total amount of Bitcoin that can be mined is limited as well. This is why people are rushing to get their hands on these cryptocurrencies as soon as they can. If people can get a hold of the cryptocurrencies sooner and at a lower value, they'll be able to sell them off for significant profits. Another reason behind the popularity of cryptocurrencies is that there's zero interference from central banks and governments. The banks can't control the supply of these cryptocurrencies, and the inflationary pressures can be minimized due to this very reason. No one likes to be at the mercy of an institution run by a handful of people, and cryptocurrencies are paving the way for that very independence. A small group of investors is also interested in cryptocurrency due to the technology behind it. These people are more curious than profit-minded, which is why they like to invest in cryptocurrencies. These people are staunch supporters of privacy and self-regulation, which is why they back blockchain-enabled cryptocurrencies. The security that's offered by blockchains is also very appealing since there are practically no risks involved like fraud or counterfeit money. Lastly, another huge reason behind the popularity of this technology is its short-term profitability. Since investors are always looking for new ways to make more money than before, the cryptocurrency market is a perfect place to double, triple, or even quadruple the initial investment. These investments are usually not done for the long term due to the volatile nature of cryptocurrency. However, vigilant investors can easily increase their money in the short term. Should you be investing in cryptocurrencies? Now that you know all the basics of cryptocurrency, the burning question on your mind must be if you should actually put your hard-earned money into something that's so new. The answer to this question can be a bit more complicated than a simple yes or no. This is because cryptocurrencies come with their own share of risks and benefits, just like any other investment. Many things can go wrong. Many things can go right. Many veteran investors don't consider cryptocurrencies to be a stable and viable investment. They merely tag it as speculation that's bound to take a dip, a huge dip for that matter. However, this isn't something that you can just brush off because it holds some truth. Cryptocurrencies differ from stocks in the sense that stocks generate money due to the company's increasing profits. However, cryptocurrencies can't just generate profits inherently because they're only a digitized version of the same old currency. The only way you can make money with cryptocurrency is if someone has to pay more than you did, but if everyone decides to withdraw their funds, the cryptocurrency's value will take a plunge. Even the great investment magnate Warren Buffett himself has said a few key things about the beloved Bitcoin. He compared it to a paper check because it can be used very efficiently to transfer money from one party to another. The advantage of cryptocurrency is its anonymity. However, a check isn't worth any money if it's blank, and the same could be said about cryptocurrencies as well. Cryptocurrencies can be used to transmit money, but they can never have an intrinsic value of their own. Another issue that plagues cryptocurrencies is stability. Even the much-touted Bitcoin has seen its fair share of fluctuations throughout its existence. From 2017 to 2020, the value of Bitcoin changed from $20,000 to a mere $3,200, and it should be a cause for concern. However, you can also argue that Bitcoin recovered its position, and that it's still more profitable than the majority of stocks. Nothing is without its flaws, and cryptocurrencies can't be expected to be flawless either. What should matter to you as an investor is the profits you can turn from an investment. If we go by the numbers, then the cryptocurrencies definitely paint a convincing picture. You have to be wise and cautious while investing in cryptocurrencies, but that goes for every other type of investment as well. How to invest. By now, you're aware of all the advantages and the possible pitfalls of cryptocurrencies. These points should make you feel confident in any decision you make. However, if you've decided to take the plunge and invest in lucrative cryptocurrencies, you should be wondering how to invest in them. The most renowned cryptocurrencies like Bitcoin can easily be bought using US dollars. If you want to buy a lesser-known cryptocurrency that's just making its mark, you'll have to use a third-party wallet that requires you to make your purchases using Bitcoins or any other accepted cryptocurrency. A wallet is essentially an online app that acts as a repository for all your cryptocurrency. You can create an account in under a few minutes, and that'll make you eligible to buy on the cryptocurrency exchange. This wallet can be used to both sell and buy these cryptocurrencies, and many of the online brokers who offer these wallets are now also offering their own cryptocurrencies. If you want to balance out your investment portfolio, you should definitely look into cryptocurrencies, as they can help you establish a much more well-rounded profile. Cryptocurrencies can offer you many benefits that aren't seen in the case of traditional bonds, mutual funds, and stocks. Unlike these traditional instruments, the cryptocurrency you buy is completely immune to any potential seizures or freezes by the local authorities of any nation. Final advice. It's all well and good if you want to invest in cryptocurrency, but there are a few key things you should keep in mind while doing so. Following these guidelines will help you protect yourself against any investments that might sink in the near future. You should be especially careful while buying ICOs, as they can be rather risky to dip your toes in. Try to find out as much as you can about the company that's offering this ICO, and you'll be able to determine the future prospects of your investment. You should know who owns the company and if they're reputed or not. If you look at the other major investors putting their money into this ICO, you can safely go ahead, as it increases the legitimacy of the cryptocurrency. If a cryptocurrency is already established, then you'll be at a much lower risk of losing your money, but if the company is just raising money to develop it further, you're obviously at a higher risk. It all depends on the amount of risk you're willing to take, and the simple rule of higher risks equals higher profits applies here as well. It can be a long and challenging road to find the new prospects that hold the most promise, but this research is part of the investing process itself. All the investors do their homework before they make the final bid or purchase, and you'll have to do the same as well. Even if a cryptocurrency appears legitimate and full of promise, it doesn't necessarily mean that it will be successful. You'll have to brace yourself for some losses, at least initially. This book will discuss many of the concepts further in detail so that you can achieve greater clarity about cryptocurrencies. This introduction will provide you with a solid foundation to build upon, and you'll be able to grasp the associated concepts more easily. Remember that investing takes time and knowledge. You'll be equipped with proper knowledge in the future chapters, but time will have to be an investment that you make. Blockchain. You might have heard the term blockchain being used in regard to cryptocurrencies and how blockchain makes it possible for cryptocurrencies to be as secure as they are. However, more than just security, the blockchain technology itself has several features and traits which make it possible for cryptocurrency to exist and function the way it does. This chapter will explore everything you need to know about blockchain technology and how this information will relate to cryptocurrencies. History. While many people know that blockchain came into being in 2008 when Satoshi Nakamoto developed the design for a blockchain that would support digital currencies, the concept of blockchain already existed long before. In fact, it was in 1991 when Stuart Haber and Scott Stornetta developed the blockchain system. However, back in 1991, it was very different from what it is today. There is no doubt that the modifications made by Nakamoto made it possible for blockchain to be such a perfect match for cryptocurrencies. Though it should be kept in mind that blockchain was not originally designed to work with cryptocurrencies. In the beginning, it was simply a database management system, which in many applications it still is, but the way that it manages data has evolved and improved quite drastically. Purpose. At its core, blockchain technology is a database management system with a number of unique features, which makes it a very versatile technology. Due to its flexible nature, various security features, and unique types of functionality, it is a great basis for cryptocurrency and is also widely used in various other applications. A digital database can be described as a system that electronically stores different types of data and information on a computer system. Moreover, databases use different sorting and classification criteria to organize the information to make it easy to access. The main difference between a database and any other kind of data storage system is that a database allows multiple users to access information simultaneously while also giving them the ability to modify the information simultaneously. Moreover, databases allow people to store significantly larger amounts of data than other storage systems. The fact that this information is digitally stored means it can be accessed by people from any location as long as they can connect with the server. Blockchain and cryptocurrency. Generally, databases are owned by a person or business. The entity that owns a database also owns the server that the database exists on. One of the major differences between blockchain and other database systems becomes prominent, which is through a characteristic of blockchain known as distributed ledger technology, DLT. The blockchain is a database that stores transactions, much like a ledger used in accounting, though the way it stores this information makes it unique. This is where it is important to keep in mind the structure of a blockchain to better understand its capabilities in the context of cryptocurrencies. As the name implies, a blockchain can be seen as a chain that consists of blocks. Information is grouped together and stored in a block. Each block has a certain capacity, and once it has been filled with as much information as it can store, a new block is created to store more information. This new block is added to the chain of existing blocks, creating a blockchain. Unlike other databases, in a blockchain, information is not stored in tables. Moreover, each block of information is created with a timestamp, and information on the block is stored chronologically. Blockchain is known as a DLT because the entire blockchain doesn't exist on a computer or group of computers owned and operated by a single individual. Instead, the blockchains of cryptocurrencies rely on hosts known as nodes, which are computers or groups of computers owned and operated by different individuals or groups of people worldwide. This is great for the system's longevity and means that if one set of computers is damaged or fails, the blockchain still exists on other nodes. Moreover, each node stores the entire blockchain, and it is a complete repository of all the information that the database holds, whereas computers in a traditional database each hold sections of the entire database. A few cryptocurrencies have a centralized storage system, though most rely on this DLT approach. In the context of cryptocurrencies, the blockchain is a database that stores all the information about each transaction that occurs. Every trade of the cryptocurrency since the inception of the currency is recorded and stored on the blockchain, and users can verify every transaction. Why DLT? The distributed ledger technology holds many benefits for both the cryptocurrency and the users of the currency. While DLT has many benefits to blockchain in general and benefits many different operations that employ blockchain, to better understand the advantages of DLT, let's look at it in light of a cryptocurrency. Decentralization. As a blockchain is hosted on several computer networks around the globe, it significantly reduces the risk of data being lost and the cryptocurrency being compromised even if one node is damaged or compromised. Moreover, since each node has a complete record of the data, each node is important and can be used as a recovery point at any time. Since all transactions that happen on the currency are being updated to the nodes in real time, there is no problem with nodes needing updates or syncing. Secondly, if one node has an error or makes a mistake in recording a certain transaction, it has thousands of other nodes to reference to verify a transaction and correct its records. But more importantly, this eliminates the possibility of one node changing its own information deliberately. If it were to do so, there would be a visible incoherence in the system, as no other node will have that entry, making it obvious that something has been tampered with. Moreover, this process also serves as a strict security check, since every transaction is verified with each node before being recorded by the blockchain. It becomes impossible to undo an entry. If one node says that an entry is incorrect and other nodes have already accepted it, it is not possible. Had it been incorrect, it would not have passed the validation process, which required the approval of all other nodes. So not only can entries not be changed and altered, but they are also permanent and cannot be reversed either, making it a highly secure form of data storage. While this works really well for currencies, it's also important to note that it is an extremely valuable tool for other sensitive information such as contracts, inventory information, individual ID information, and nearly any other kind of information. If someone did decide to tamper with the information in a node and change some information stored on a specific block, they would need to access that block on every other node, or at least the majority of all other nodes. And they would have to make that same change so that the majority of nodes would agree that the information change was correct, hence causing the remaining nodes to also change that information. However, considering the number of nodes and the fact that it is not easy to gain unauthorized access to a node, that is extremely unlikely. Visibility. The fact that a cryptocurrency's blockchain is delegated to various nodes throughout the world has two main benefits in terms of the visibility of the system. Firstly, those who have a personal node or have access to a node can actually see the transactions that are taking place in real time. However, the general population can also use a blockchain explorer to get access to this same information. This increases the trust that people have in the system, as they can see what is happening. And all this information is stored so they can even refer to it in the future. Secondly, while the identities of the people making transactions are more difficult to decipher, it is much easier to see the value of transactions and the associated currency used to make this transaction. This makes it possible for a person to easily see the life cycle and journey of one specific token on the cryptocurrency. You can literally see where this token started off and see all the transactions that it has been a part of. This is also an incredible security feature. If a token is stolen or an entire exchange is compromised, even though you can't see who is making a transaction, you can easily spot if someone is using stolen currency. This makes it very easy to keep the currency safe, as anyone who steals it will not be able to do much with it. Security. While several features and functions of the blockchain do add security, there are other things that the blockchain does directly to enhance its security. Blockchain technology employs a feature known as the hash. When blocks are compiled in a blockchain, they follow a linear path. Each new block is placed above the previous block, and in this manner, the blockchain grows in height. Every time a block is generated and added to the blockchain, it has its own unique hash as well as the hash of the block before it, together with its timestamp. Generating the hash is a complex process, as the hash is a mathematical function of the information within the block represented in the form of an alphanumeric code. Therefore, if the information contained within the block is altered, the correlated hash code also changes. This effect carries on to the next block as well. In this way, a small change in the information in one block leaves a visible effect on the hash code, which becomes an inconsistency that is easy to spot. Therefore, if someone wanted to beat the system successfully, not only would they have to alter the information in that block in the majority of the nodes that exist, even if they chose just to alter the information on their own node, they would still need access to a lot of other nodes for that change to be accepted and implemented across the blockchain. While this may be possible in a very small blockchain, Considering this approach for a large, well-established cryptocurrency is not feasible. There are hundreds of thousands of nodes even in the smaller mainstream cryptocurrencies, and the amount of money it would cost, together with the amount of expertise that would be needed, simply isn't possible. Moreover, even if it were possible, with so many people watching the cryptocurrency, people would easily detect this unusual activity and identify it as an attack. If somehow the attack was successful, node owners would simply abandon that block and take a fresh start from the previous unaffected blocks, making this entire endeavor useless. Blockchain at large. Blockchain has a lot of functionality outside of the cryptocurrency realm. In fact, cryptocurrency has merely acted as a catalyst to market the power of blockchain as a system, and people from all walks of life understand how they can make use of blockchain in their trade. Blockchain has been especially useful in the financial services market, particularly in the asset management area. Prior to blockchain, systems were slow, prone to error, and rather labor-intensive. Moreover, the entire process for specific activities, such as asset management, required a lot of people to keep track of what was going on their own accord. Everyone from the broker to the custodian to the end client was responsible for documenting the process and keeping a copy for reference. The entire process has become far less risky through blockchain, much more transparent for everyone involved, and very easy to do as everyone can collaborate on one shared platform. Similarly, those that work an insurance claim also have to go through a lot of paperwork, and they have to sift through a lot of files which are already quite weak to begin with. There is a high risk of fraudulent claims, expired policies, and poorly gathered data, considering that this is all done manually. Not only is it labor-intensive, but there is also a strong possibility of error. Through the blockchain mechanism, all of these things can be streamlined, and the encryption tool of the platform allows for excellent security. While there are many solutions for global payment, many of these systems are not very efficient. Even though there are banks and proper global payment platforms, getting money to a different country can be a lengthy process. Moreover, the institutions that facilitate this process often charge a high fee, take several days to process, and there is no way to stop money laundering. The blockchain platform has proven to be very effective in the remittance market, and many of the existing global payment service providers are incorporating blockchain technology to enhance their services. On the other hand, several new companies rely solely on the blockchain mechanism and use this platform as their unique feature to attract clients. Through the blockchain system, global payments are not only done instantly, but they are far more secure for everyone involved. The sender, the receiver, and the intermediary know exactly what's going on. For governments, this has proven to be a magical instrument as it allowed them to have more control over how money flows in and out of their country. However, as there are still a lot of remittance services that rely on traditional systems, money laundering is still not completely under control, but it seems far more possible to manage this problem. Difficulties with blockchain. While it is a wonderful system with many benefits for many professions, it still does have its fair share of drawbacks. Something less known about blockchain is its extremely high fuel requirements. It is a digital system that runs on electricity, but it requires an incredible amount of power to run, and creating electricity is not very environmentally friendly. Some of the top cryptocurrencies using blockchain consume more electricity than entire countries do. In fact, they use more electricity than what would be used by dozens of countries put together. On the other hand, while the complexity of the blockchain is what we are benefiting from, it is also something that hinders this technology. It is complex, making it difficult for people to understand how it works, and eventually making them less likely to use it. And it also makes it a very difficult market to enter since people don't know enough about it to actually benefit from it by incorporating it into their businesses and daily lives. While it is a simple system, in theory, applying it to a certain problem in a certain industry is a challenging task. Cryptocurrency mining. Cryptocurrency mining is a critical component that helps in the development and maintenance of the blockchain ledger. It also involves the process of the creation of cryptocurrency and how it is introduced in circulation. Different things are involved in crypto mining, which has been popular with miners, cybercriminals, and investors. This chapter discusses in detail the concept of cryptocurrency mining and how it works. What is cryptocurrency mining? Crypto mining is a process that involves the verification of transactions between different users. The data blocks are validated, which helps add transaction records to the blockchain public ledger, which is also known as a public record. The process of crypto mining also involves the creation of new cryptocurrencies through the process of solving puzzles or cryptographic equations using computers. The introduction of new coins in the supply circulation is one of the key factors that allow different cryptocurrencies to work as a decentralized network. As a result, cryptocurrencies do not require the central authority of a third party like fiat currency. The central bank regulates fiat currency in any country. Crypto mining plays a pivotal role in maintaining all ledger transactions to ensure that they are verified easily. The miners use complex machinery to solve math problems within the crypto network. The mining operation produces a new crypto, and Bitcoin is one of the most popular cryptocurrencies. The miners also make the crypto payment network secure and trustworthy by solving computational problems. Mining also helps in verifying all transaction information. How does cryptocurrency mining work? If you are interested in cryptocurrency mining, you should know that the exercise is rewarding. Many investors consider crypto mining because the miners are handsomely rewarded with crypto tokens for their great work. However, before you invest in cryptocurrency mining, there are different things that you should know about how the concept works. A miner is viewed as a node in a network that plays a role in collecting transactions and organizing them into blocks. The network nodes or miners will receive information about all transactions made, and they are responsible for verifying their validity. The miner nodes will begin to gather these transactions from a memory pool and assemble them into a block. The first stage in mining a block involves hashing every transaction that is obtained from a memory pool. The miner node will add a transaction where he awards himself a block reward or mining reward before they begin the mining process. The transaction involving a block reward is known as the coin base, and this is where cryptos or coins are created from nowhere. This usually involves the first transaction that is recorded in the new block. When each transaction has been hashed, we get what is called hashes, organized into a hash tree or Merkle tree. This tree comes from organizing different transactions into pairs that are hashed together. You repeat the process of pairing the outputs and hashing them until you reach the top of the tree, a hash tree. The top part of this tree is known as Merkle root or root hash. The top hash appears as a single hash that will represent the previous hashes used to build it. Together, with the hash belonging to the previous block, the root hash and a random number known as a nonce are put into the block's header. This block header is again hashed to produce an output consisting of the previous elements that include root hash, nonce, and the previous block's hash together with other elements. The block hash is the output, and it will play a role as the identifier of the new block created, candidate block. The block hash or output must be less than a specific target value that is usually decided by the protocol for it to be regarded as valid. The block should begin with a particular number of zeros. This target value is also called the hashing difficulty, and the protocol regularly adjusts it while ensuring that the rate of new blocks being developed remains proportional to the level of hashing power constant to the network. As a result, whenever new miners are joining the network, competition will increase, thereby raising the hashing difficulty. The average block time is prevented from decreasing. In contrast, the hashing difficulty goes down when the miners choose to leave the network. The block time is maintained at a constant level, although there will be less computational power that is dedicated to any network. The mining process compels the miners to continue hashing the block header repeatedly through the nonce until the time when one miner in the network ultimately provides a valid block has. The attainment of a valid has means that the founder node then broadcasts the block on the network. This hash is verified and validated by all other nodes. After validating the block, they add it into their blockchain, then move on to the next stage of mining another block. If two miners simultaneously broadcast a valid block, The result is that the network may end up having two competing blocks. The miners will use the block first received to start mining the next block. In the meantime, the two blocks continue to compete until the time when the next block is mined. One of the blocks will be abandoned in the process, and it is called the stale block or orphan block. Eventually, the miners of this block then switch back to the process of mining the winning block's chain. In brief, crypto miners play a pivotal role in verifying the legitimacy of transactions to get rewards for their work. The rewards come in the form of cryptocurrency that helps to create a new currency. You need to understand how blockchain works to gain a full understanding of cryptocurrency mining. The following are the key takeaways of cryptocurrency mining. Through mining, you earn cryptocurrency without investing any money. Miners earn cryptocurrency for completing verified transactions or blocks that are added to the blockchain. A miner who discovers the solution to a complex puzzle wins the rewards. The mining power in the network determines your probability of discovering a solution to complex hashing puzzles. To solve complex puzzles, you will need an application-specific integrated circuit, ASIC, or graphics processing unit to help you set up a mining rig. The following section outlines the technology you will need to succeed in crypto mining. Mining hardware. If you want to build a system that you can use for mining cryptocurrency, you need to get powerful hardware to get started. First and foremost, you must acquire a mining rig or a customized PC that consists of common elements, including RAM, motherboard, CPU, and storage. However, the graphics cards required significantly differ as a result of the hard work involved in cryptocurrency mining. You will need a powerful GPU, and the chances of buying more than one will be very high. You will need to connect more graphics cards to the motherboard, and you also need more power supply to operate the system. You also need a motherboard that is capable of accommodating more graphics cards. Other motherboards can accommodate up to 19 graphics cards, but they require a specific layout that you should follow. You also need the Intel Core i5 CPU, and you do not necessarily need to overspend on this one since it works perfectly well with the ideal motherboard. Other forms of hardware that you will need to include RAM, PSU, storage, PCIe riser, NVIDIA graphics card, and AMD graphics card. On top of the hardware, you also need to get an appropriate power supply to operate the hardware. In other words, you should get insight into the kind of equipment required to mine cryptocurrency successfully. If you are interested in mining competitively, you must invest in high-quality and powerful computer equipment that include GPU or application-specific integrated circuit, ASIC. These components can cost you thousands of dollars. You need to get a fast mining rig, or else you may consider joining a mining pool, as you will see below. Mining software. Cryptocurrency mining involves the use of sophisticated computers to solve computational math problems that are extremely complex. As a result, you need to get the appropriate software after getting your hardware. Choosing the right program for your computer will help to connect you to the blockchain network. Essentially, mining software is designed to deliver work to the miners, collect results for the work done, and add the information to the blockchain. The other purpose of crypto mining software is to monitor all the miners' activities. It shows crucial statistics like cooling, temperature, average mining speed, and hash rate. There are also free programs that you can consider to mine cryptocurrency like bitcoins. Some of these programs can run on different operating systems, but they also come with advantages and disadvantages that you must know. Mining pools, in particular, provide their software to their miners. Mining software can be customized to suit the needs of the miners. Software like NiceHash Miner is good for beginners since it is easy to use and it can mine several cryptocurrencies. The software automatically chooses the best algorithm that is profitable. All you need to do is download the software and install it on the device that you would like to use for mining. The advantage of crypto mining software is that it helps to secure the decentralized digital currency. Crypto mining software also helps you to earn cryptocurrency without investing any money. Additionally, you should also know that cryptocurrency works well in conjunction with mining hardware. In other words, the software helps you connect your mining pool with the hardware. When choosing mining software, make sure that it is user-friendly. Mining pools. The block usually grants the miner who solves the problem or first discovers the hash a reward, but the probability of getting the hash constitutes the combined mining power of the entire network. As a result, mining pools are specifically created to help solve this challenge. As the name suggests, pooling involves a process of combining computational resources by the miners who all share the power to process different activities over a network. This will help to ensure that the reward is split equally among every participant in the pool. The reward is allocated according to one's amount of work they contribute to improving the probability of getting the block. If you are interested in making a profit through cryptocurrency mining, you have a choice of joining a mining pool where all the miners combine their devices to increase hashing output, or go solo. There are different methods of mining pools, and they do not operate the same way. Proportional pooling is the most common method, and the miners receive shares according to the pool's success in finding the block. Later on, the miners get rewards that are proportional to the shares they hold. Pay per share is another pooling method that gives miners shares according to their contributions. The miners get instant payouts. The other method is peer-to-peer pool mining that aims to prevent the centralization of the pool structure. The primary benefit of a mining pool is that it promotes teamwork, which increases the chances of success. While you can go solo where you get full ownership of the reward, chances of succeeding are slim because of the requirements of the resources. Mining cryptocurrency is costly since it requires costly hardware and high electricity costs. However, when you are operating as a team, you will use fewer resources in terms of electricity and hardware, which improves the success rate. Mineable cryptocurrency. Bitcoin is probably the most popular form of cryptocurrency to date. The concept of cryptocurrency mining started with Bitcoin in 2009, and it has since gained widespread acceptance in other cryptos. For greater rewards, small miners must work with big pools for better rewards. Not all cryptocurrencies can be mined as a result of several reasons. There are more than 10,000 cryptocurrencies available, and the mineable ones use application-specific integrated circuit, ASIC, that is designed to mine certain crypto assets. If you do not upgrade your ASIC miner, it can be difficult for you to compete with other miners actively. To choose the crypto to mine, you must first check the exchanges that support the coin. Coins supported by less popular exchanges can be difficult to withdraw since you can only do it to the internal wallet. You must know if it is possible to withdraw your cryptocurrency to fiat. The miner can end up paying heavy commissions for withdrawals. You also need to ensure that cryptocurrency mining is legal in your country, as explained in detail below. Before you buy the mining equipment, you must evaluate its long-term use. You must go through different reviews to get insights into the mineable cryptocurrencies. Is cryptocurrency mining legal? You need to question the legality of cryptocurrency mining to be on the safe side. Your geographic location determines whether crypto mining is legal or not. The concept of cryptocurrency can undermine the dominance of government control of fiat currencies in the financial markets. As you are now aware, cryptocurrency is not controlled by a central bank like fiat currency. In other places like China, Pakistan, Egypt, Morocco, Bolivia, Nepal, Algeria, and Ecuador, cryptocurrency mining and ownership are illegal. However, cryptocurrency use is increasingly becoming legal across different parts of the globe. You also need to understand the risks of crypto mining, which often come as financial and regulatory. Crypto mining is generally a financial risk, as highlighted above. Often spending thousands investing in mining equipment, you may only realize later that the return on investment is nil. In other countries, there are sets of regulations that prohibit the practice of crypto mining. Therefore, you need to research the countries where cryptocurrency mining is legal before you get into it. In brief, crypto mining refers to the process of working complex computational puzzles to earn cryptocurrency as a reward for the finished work. People usually mine crypto to get an additional source of income. Mining cryptocurrency involves the process of verifying all the transactions between different users. After validating the transactions, they are added to the blockchain public record. In other words, the entire process of crypto mining involves the creation of cryptocurrencies through solving complex problems with a computer. There are also other reasons why you can consider cryptocurrency mining or trading. Some people turn to cryptocurrency trading because it is flexible. and it gives them financial freedom. Unlike fiat currency that is centralized and controlled by a central government, cryptocurrency is decentralized. The area of cryptocurrency mining is significantly gaining popularity with many investors. However, it is also attracting cybercriminals who are bent on trying their luck. Types of cryptocurrencies. As of January 2021, there were over 4,000 listed cryptocurrencies in existence. Although many of them have very zero to little trading volume, others are highly popular among e-commerce communities, other devoted communities, and many investors. Did you know that just 3 years ago, during 2018, there were just 1,583 listed cryptocurrencies on CoinMarketCap.com, and that there are currently only 180 fiat currencies in the world? You are probably wondering why there are so many cryptocurrencies and what sets them apart from one another. Just 12 years ago, in 2009, Bitcoin was the only cryptocurrency there is. Today, we have cryptocurrencies, more or less, designated for each sector of the economy. All of these cryptocurrencies virtually have the same goal. The goal is leveraging blockchain technology to restructure fields such as finance, energy, health, data storage, security, privacy, payments, machine learning, social networking, content ownership, logistics and supply, and other areas of equally high diversity. You may be thinking that so many cryptocurrencies already exist, so what exactly is the main reason behind their expansive growth and proliferation? The reason is quite simple. Each cryptocurrency serves a different purpose and has distinct functionalities. Typically, the primary blockchain is perhaps why we have so many different cryptocurrencies. It basically gives developers the scope needed to create several cryptocurrencies to tackle different functionalities. It goes without saying that there are cryptocurrencies that serve the purpose of a normal currency. Like regular fiat ones, these currencies have a set value that can be essentially used to make purchases or for trade in general. The popular Bitcoin falls under this cryptocurrency umbrella. Other cryptocurrencies, however, may fall under the function of utility. This means that there are groups of cryptocurrencies that are developed as an infrastructure. This means that they allow other cryptocurrencies to be forged on top of their own networks. For example, Ethereum, which we will be discussing in more depth throughout this chapter, and Ethereum Virtual Machine fall under this category. Ethereum, with its ladder blockchain-based software platform, allows several tokens to be created on its network. The other major types of cryptocurrencies, which are referred to as platform or app cryptocurrencies, are made to be built on top of other utility currencies. One great example of this type of cryptocurrency is the Augur cryptocurrency that was established on the Ethereum network. This, in short, explains the need for, or rather the reason behind the existence of, many different cryptocurrencies. Keep in mind that blockchain technology is not really under anyone's control. Simply put, anyone who is knowledgeable enough about the inner workings of the technology can make their own cryptocurrency. If you look back at how this whole virtual technology phenomenon started out, the first one to use blockchain technology was Satoshi Nakamoto. He came up with Bitcoin and was the first one to implement this understanding into something this revolutionary. It wasn't long after that other developers realized that they might be able to expand on Nakamoto's idea, exploiting this technology to create more innovative and perhaps better versions of Bitcoin. One of the first altcoin creators, Charlie Lee, who was also a former Google engineer, played a great role in the creation of Litecoin. This was when many others joined the quest to create something even larger than Bitcoin. One other reason why there are this many cryptocurrencies in the world may be due to the fact that Bitcoin, among a few other altcoins, has witnessed a great deal of success. When Bitcoin first came out, many people referred to it as the monkey business. Not many people understood it, and others thought it would be a scam in the long run. It was, to a great extent, highly disregarded. Bitcoin, at the time, had no value. Because it didn't seem promising, very few people actually thought to understand it. However, it proved to show immense success and value over the years. Similarly, Ethereum was practically worthless until the beginning of 2017. It was during 2017 that Bitcoin and the other altcoins thrived. It was when Bitcoin's value rose to $20,000 per BTC. It was also when many people started to turn their heads to the world of cryptocurrency. In this chapter, we will explore the most popular cryptocurrencies in more depth. Bitcoin. Bitcoin is a decentralized digital currency that can be sold, bought, and directly exchanged. You don't need an intermediary or a bank to handle your Bitcoins. There is a public ledger that anyone can access to view every Bitcoin transaction ever made. This ledger makes transactions hard to fake or reverse. The value of Bitcoins is purely determined by its system, meaning that no issuing institution or government is backing the currency. Bitcoin is built on blockchain, which has already been covered extensively in the previous chapters. Many people think of Bitcoin as an alternative investment or a way to diversify one's portfolio beyond bonds and stocks. While it can be used to make purchases, not many vendors accept Bitcoin as means of payment. Some services also allow you to connect your crypto account to your personal debit card. You can buy Bitcoins via exchanges, which work almost similarly to brokerage accounts. You will need a digital wallet, either hot or cold, to store your coins. Hot or online wallets are ones where you store your coins in the cloud through a provider or exchange. A cold or mobile wallet allows you to store your coins on an offline device. You can invest in Bitcoins through special retirement accounts or Bitcoin mutual funds. Ethereum. Like every other cryptocurrency, Ethereum is a decentralized currency that is built on the principles of a blockchain network. Everyone in the Ethereum network gets a copy of a ledger that allows them to see all transactions. Like Bitcoin, Ethereum can be bought, sold, and used to make purchases. Many people invest in Ethereum because of its rapid success and rapidly increasing value. Ethereum, however, is different in the sense that it allows users to create applications that can be run on the blockchain. This is similar to how software runs on a computer. These applications can be designed to deal with intricate financial transactions and transfer and store personal data. Ethereum is unique because it can perform various functions. Other than being a currency and its ability to hold financial transactions, Ethereum can be used to perform smart contracts. Third-party users may also use it to store data. It is also characterized by its constant innovation, huge, already existing network, and a lack of intermediaries. Its only disadvantages may be that it has a high inflation potential, its transaction costs are soaring, it is difficult for developers to pick up, and it holds a rather uncertain future. To buy Ethereum, you can choose a cryptocurrency exchange, deposit actual fiat money, or buy Ether along with other assets at the current Ethereum price. You can use a different wallet to store your coins instead of using your trading platform's standard digital wallet, as using it can be a security risk. Binance Coin. Binance Exchange and Trade is a platform that issued Binance Coin. This cryptocurrency with the BNB symbol started out on the Ethereum blockchain. However, it is now a separate entity of the Binance chain. 1/5 of Binance's profits are designated to the permanent burning of the Binance coins in its treasury each year. It was initially created to serve as a discounted trading fees utility token in 2017. However, it has since grown to encompass various other applications, like travel bookings, transaction fee payments, entertainment, financial services, and many other online services. According to a Bloomberg report, the Justice Department and Internal Revenue Service are currently investigating Binance Coin as of May 13, 2021. Tether. Tether, which trades as USDT, was previously known as Realcoin and was established by Tether Operations Limited in 2014. This entity was created by Bitfinex, which is a Hong Kong-based cryptocurrency exchange. Tether is designed to function as a stablecoin or a cryptocurrency that is attached to real-time commodities or assets. Its function is to help guarantee value stability and eliminate market volatility, which is why investors use it. Because it serves to safeguard financial stability in case the crypto market ultimately crashes, Tether is at an advantage over Ethereum and Bitcoin. Similarly, Tether can be attached to fiat currencies like the US dollar, Swiss franc, euro, metals, and other precious commodities. Tether claims that it circulates the cryptocurrency market at a 1-to-1 ratio with the US dollar. You can buy Tether at a global exchange program. While Tether is the first ever stablecoin, it seems to fail to live up to its claims. Many people question the extent of this stablecoin's legitimacy and whether the number of US dollars in its reserves matches the number of Tether in circulation. Other people believe that Tether was never an actual cryptocurrency and that its creation was an attempt to manipulate Bitcoin's market position and value. Moreover, the cryptocurrency experienced trouble with US financial regulators and banks. These troubles ranged from insufficient documentation loss cover-up to embezzlement. Cardano. Cardano, a third-generation decentralized cryptocurrency, is designed to be a more efficient alternative to the proof-of-work networks. This is because it is designed on a proof-of-stake blockchain platform. This blockchain platform allows people to validate or block transactions according to the number of coins that they hold. Proof-of-work networks, like Ethereum, are characterized by their sustainability, scalability, and interoperability, and it has become exceptionally hard to deal with their increased energy use, growing costs, and sluggish transaction times. Charles Hoskinson, Ethereum's co-founder, in turn, understood the complications that came along with the proof-of-work networks and decided to work on Cardano to provide plausible solutions to these challenges. Cardano, in its foundation stages, created the Ouroboros consensus protocol, which it uses to run. Ouroboros is the first consensus protocol that proves to be secure and is extensively supported by academic research. The first Cardano product resumed being advertised as an identity management tool that allows access to various services. For instance, eligibility for government aid and credentials needed to open a bank account can both be verified using Cardano. The two other products that Cardano markets use a supply chain to trace the journey of products. A smart contract platform, similar to Ethereum, is also being developed by Cardano. This smart contract platform can be used to develop decentralized apps on an enterprise level. Project Catalyst, a democratic on-chain governance system, will also be used by Cardano's team to manage the execution of various projects. You can buy Cardano by opening an online exchange account and purchasing an optional wallet for security purposes. Polkadot. Polkadot is also a third-generation blockchain protocol that is designed to connect several specialized blockchains into a united network. Polkadot is created to serve as a portion of a great vision, which is essentially a web where users are back in control over the different internet monopolies. It is built on the foundations of other blockchain networks. However, it still offers other substantial benefits. Since Polkadot is a sharded multi-chain network, it is able to process numerous transactions that occur on different chains simultaneously, unlike other blockchains in isolation that can only process a limited or specific amount of traffic. This means that Polkadot can get rid of the bottlenecks that other legacy networks may have experienced. This gives this cryptocurrency the advantage of being highly scalable, as it allows it to adopt the right environment needed to grow in the future. Parachains are the sharded chains that are associated with Polkadot. This name references the ability to run parallelly on the network. With blockchain networks, there is no such thing as a mold. There are, however, trade-offs. This means that each cryptocurrency has to give up something in return for a specific feature or function. While one chain may serve as an identity management system, another may be great at file storage. When it comes to Polkadot, there are various blockchains with innovative designs that are perfected for a certain use. This means that you have optimal effectiveness, efficiency, services, and security. Because it uses a substrate development framework, each team's blockchain can be customized and developed rapidly and efficiently. You can share functionalities and data on Polkadot applications and networks, just like you would on your phone. This entails that you don't have to resort to centralized service providers for additional costs. This is because Polkadot provides cross-chain communication and interoperability, making it ideal for the development of creative services and the transferring of information across chains. On Polkadot, you are allowed to govern your networks however you like. Generally speaking, there is a see-through stake in Polkadot's entire network governance. You can customize these networks on your blockchain to suit your needs, which would allow you to experiment and switch out ready-made modules. You can easily upgrade and tweak your models as you go. Ripple. Ripple, a currency exchange network and payment settlement system, supports global transactions. Ripple functions as a trusted agent or intermediary between two different entities throughout a transaction. This network can help you determine whether your transaction or exchange has seamlessly gone through. It can help make exchanges between various fiat currencies, cryptocurrencies, and other commodities, like gold and silver, a much easier process. When you make a transaction using Ripple, it deducts a rather small amount of XRP, which is a cryptocurrency that runs on the XRP ledger. 0.00001 XRP is the standard transaction fee on Ripple. Besides functioning as a means to facilitate transactions, XRP can be used as an investment. Ripple is characterized by its vast settlement and transaction confirmation, very low fees, versatile exchange network that encompasses fiat currencies, cryptocurrencies, and commodities, and the fact that huge entities use it. The disadvantage of using Ripple may be that it is rather centralized and has a large pre-mined XRP supply. It should also be noted that the SEC filed a lawsuit against Ripple in 2020. Litecoin. Litecoin is a peer-to-peer decentralized virtual currency. With Litecoin, you can make almost no-cost, instant payments. These transactions can be made globally, by institutions, or sole individuals. This cryptocurrency, like Ethereum and Bitcoin, uses the proof-of-work algorithm to secure its network. As we hinted above, this algorithm required a party to prove to the other involved parties in the same network that a certain transactional amount has been expended. Litecoin can be used as a method of paying other parties located anywhere on Earth. It doesn't require you to resort to an intermediary to have your transactions processed. Chainlink. Chainlink is an Oracle network that donates real-time data to the blockchain's smart contracts. Like other cryptocurrencies, Chainlink is decentralized. As you can infer from the name, the digital asset token that's used to pay for the network services is called Link. The good thing about the currency is that its verifiable and immutable smart contracts are automatically executed in the framework constructed in an if/then structure whenever the conditions are met. Additionally, oracles on blockchain networks can bring off-chain information to on-chain smart networks. However, since oracles may be faulty, they may counteract the benefits of on-chain smart networks. Stellar. Stellar has many similarities to Ripple. For one, it is a payment technology whose goal is to bring financial institutions together and eliminate the time and costs of cross-border transfers. Both networks have also initially used the same protocol. A decentralized server network is run along with a distributed ledger. This ledger is typically updated every 2 to 5 seconds on every node. What sets Stellar and Bitcoin apart is Stellar's consensus protocol. This protocol doesn't require the whole miner network to approve transactions and uses the federated Byzantine agreement algorithm in its place. Innovation is also a great driving factor behind the abundance of cryptocurrencies. We humans, by nature, are innovation-driven. We are constantly in search of improvement, and similarly, cryptocurrencies are too. While many cryptocurrencies may essentially handle similar issues, they still differ in the protocol, tweaking various elements. For example, many platforms may promise a life-changing smart contracts platform. While Ethereum still remains the leading smart contracts platform, others are trying to catch up with its success in that area. If you read this chapter, then you now understand how each cryptocurrency has different services to offer.